we additionally show that high fees paid for priority transaction ordering poses a systemic risk to consensus layer security. We explain that such fees are just one form of a general phenomenon in DEXes and beyond, what we call minor extractable value, MEV, that poses concrete, measurable, consensus layer security risks. Hello, and welcome back to Ethereum Audible, Ethereum in depth, where I read the best in Web3 and the Ethereum ecosystem. Sometimes it's the best, sometimes it's the longest, sometimes it's just meh. But this is your home for all of those in-depth readings that no one else has the time or the will to do, and I'm glad that you're with me. Last week I took off. I was a little away on vacation, so pardon the break. But this week we're going back in full force, and I'm going to be taking not a break from tokenomics, just because I love the topic of tokenomics, token designs for new systems. I think that's really where crypto shines. But because we are getting closer to the merge, I want to dive deeper into the risks and kind of the lower level topics that involve the merge. And that includes topics like MEV, reorg attacks, and the different risks that are kind of at the doorstep as the merge approaches. Everyone in Ethereum land loves to be super bullish about the merge, but it's good to take a step back and consider what could go wrong. And there have been some great in-depth papers about that, but also just for ourselves to have a good idea of what are the table stakes and what are the different complications and complexities that the different Ethereum teams are dealing with. I think a lot of people don't understand the complexity involved in the merge and the beacon chain in general and proof of stake in general, and think it's just kind of an easy thing. There are lots of proof of stake chains out there. Why is Ethereum taking so long? It'll never happen. All of that FUD out there. And my goal over the next few weeks is to dive into some of the reads that will make you appreciate the complexity of this system that we're building. The Ethereum beacon chain, the proof of stake merge, and the world computer, so to say. And you might have read in the news about a 7-block reorg that happened last week, and people are saying that's why the price of Ethereum crashed. I think that's BS. The narrative is driven by the price action, not the other way around. And so Ethereum went down because everything was going down, and then you have to look for a reason for that. And so people say, oh, it's the 7-block reorg. We're going to be diving into that, but that is built on understanding these different kinds of attacks that Ethereum 2.0 is susceptible to. And there's a paper called 3 Attacks on Proof of Stake Ethereum that we're going to be reading. But to understand that, we have to take a step back and understand what MEV is. And so today we're going to start off reading. I hope this can all go into one reading, but it's pretty long and pretty dense. It's a paper called Flashboys 2.0, Front-Running, Transaction Reordering, and Consensus Instability in Decentralized Exchanges. And this is a paper that came out in April of 2019. So MEV is a topic that's been spoken about for at least 2 or 3 years. But the merge, well, I'll call it's just still at the frontier of research. And it's a pretty complex paper. And so I will see, I might in the middle kind of intersperse it with explanations just to make sure that it really does come through, even though this is an audio format and this is a dense paper. And we'll see how it goes. So before diving in, as always, I want to thank Alpe Audio. Alpe Audio, for those of you who don't know why I'm into audio education, Alpe Audio is my startup indie business bootstrapped app that is all about audio education and audio courses. We take high quality content, repackage it into audio courses so that you can learn topics in depth on the go, things like creative thinking, building in public, how to bootstrap a business, neuroscience of productivity, everyday mindfulness. There's all kinds of great stuff there. A whole series on marketing, a whole series on investing, all kinds of great audio courses that you can learn topics in depth, even do a read-through of the Bitcoin white paper. So check that out. That is how you can help me continue to do Ethereum Audible, and I really appreciate it if you download the app, check it if you want to, pay for it if you don't want to. There's 40 free minutes a week. And with that, without further ado, let's dive in for what you came here for. Flashboys 2.0, front-running, transaction reordering, and consensus instability in decentralized exchanges. Let's start with the abstract. Blockchains, and specifically smart contracts, have promised to create fair and transparent trading ecosystems. Unfortunately, we show that this promise has not been met. We document and quantify the widespread and rising deployment of arbitrage bots in blockchain systems, specifically in decentralized exchanges, or DEXes. Like high-frequency traders on Wall Street, these bots exploit inefficiencies in DEXes, paying high transaction fees and optimizing network latency to front-run, i.e. anticipate and exploit ordinary users' DEX trades. We study the breadth of DEX arbitrage bots in a subset of transactions that yield quantifiable revenue to these bots. We also study bots' profit-making strategies with a focus on blockchain-specific elements. We observe bots engage in what we call priority gas auctions, PGAs, competitively bidding up transaction fees in order to obtain priority ordering, i.e. early block positioning and execution for their transactions. PGAs, priority gas auctions, present an interesting and complex new continuous time, partial information, game theoretic model that we formalize and study. We release an interactive web portal, frontrun.me, to provide the community with real-time data on PGAs, priority gas auctions. We additionally show that high fees paid for priority transaction ordering poses a systemic risk to consensus layer security. We explain that such fees are just one form of a general phenomenon in DEXes and beyond, what we call minor extractable value, MEV, that poses concrete, measurable, consensus layer security risks. We show empirically that MEV poses a realistic threat to Ethereum today. Our work highlights the large, complex risks created by transaction ordering dependencies in smart contracts and the ways in which traditional forms of financial market exploitation are adapting to and penetrating blockchain communities. I'll just stop there for the abstract because if you understood the abstract, that's the main takeaway. Basically, just like there's high frequency trading on Wall Street where someone is front running your trade, the same thing can happen in Ethereum. And bots can be front running an order you put into a DEX. And the claim here is that that front running leads to a profit that is great enough to jeopardize the consensus layer and kind of mismatch the incentives that different consensus layer players have. And that's the risk to the consensus. So with that, let's dive into the first section, Introduction. Cryptocurrency exchanges today handle more than $10 billion in trade volume per day. The vast majority of this volume occurs in centralized exchanges, which hold custody of customer assets and settle trades. At best loosely regulated, centralized exchanges have experienced scandals ranging from high-profile thefts to malfeasance such as price manipulation. One popular alternative is what is called a decentralized exchange, or DEX. In a DEX, a smart contract program, as in a program that's executing on a blockchain, or other form of peer-to-peer network, executes exchange functionality. At first glance, decentralized exchanges seem ideally designed. They appear to provide effective price discovery and fair trading, while doing away with the drawbacks of centralized exchanges. Trades are atomically executed by a smart contract and visible on the Ethereum blockchain, providing the appearance of transparency. Funds cannot be stolen by the exchange operator because their custody and exchange logic is processed and guaranteed by the smart contract. Despite their clear benefits, however, many DEXes come with a serious and fundamental weakness. On-chain, smart contract-mediated trades are slow. Traders thus may attempt to take orders that have already been taken or cancelled, but appear active due to their views of messages sent on the network. Worse still, adversaries can front-run orders, observing them and placing their own orders with higher fees to ensure they are mined first. Past work has acknowledged transaction ordering dependence as an anti-pattern and vector for potential front-running. Unfortunately, these analyses have previously proved overly broad. Virtually every smart contract can be said to have some potential dependence on transaction order, the majority of which is benign. As a result, effective practical mitigations of these issues have failed to materialize, and few deployed smart contracts features ordering protections. And other works has focused on systematizing knowledge around smart contract front-running, including citing early public versions of this work, but it has not measured the size of this economy or formalized its connection to protocol attacks. In this work, we explain that DEX design flaws threaten underlying blockchain security. We study a community of arbitrage bots that has arisen to exploit DEX flaws. We show that these bots exhibit many similar marketing exploiting behavior, front-running, aggressive latency optimization, etc., which are common on Wall Street as revealed in the popular Michael Lewis expose, Flashboys. We explore the DEX design flaws that spawned arbitrage bots, measure and model these bots' behavior, and illuminate systematic smart contract ecosystem risks implied by our observations. Our main focuses are 1. Pure revenue opportunities, a specific subcategory of DEX arbitrage representative of broader activity. These are blockchain transactions that issue multiple trades atomically through a smart contract and profit unconditionally in every traded asset. We choose these opportunities as a focus because their simplicity makes them especially amenable to study and measurement. We experimentally determine a lower bound on this economy of over $6 million to date and describe its participating exchanges and bots. 2. Priority gas auctions, PGAs. Because pure revenue opportunities offer unconditional revenue, arbitrage bots often compete against each other by bidding up transaction fees, as in gas, in what we call PGAs. We formally model bot PGA behavior and observe a cooperative equilibrium. We show that empirical measurements of the evolution of bot PGA strategies validate key features of our model. 3. Miner extractable value, MEV. We introduce the notion of MEV, value that is extractable by miners directly from smart contracts as cryptocurrency profits. One particular source of MEV is ordering optimization fees, which result from miners' controls of the ordering of transactions in a particular epoch. PGAs, priority gas auctions, and pure revenue opportunities provide one source of optimization ordering fees. We show that MEV creates systemic consensus layer vulnerabilities. 4. Fee-based forking attacks. We show that ordering optimization fees can incentivize miners to mount forking attacks. While fee-based attacks were previously studied theoretically in Bitcoin, we empirically demonstrate a current realistic threat in Ethereum. 5. Time bandit attacks. We show that high MEV regimes in general lead to a new attack in which miners rewrite blockchain history to steal funds allocated by smart contracts in the past. We call these time bandit attacks. Our experiments show that MEV from pure revenue profits and priority gas auctions, bot fees, suffice to enable time bandit attacks on today's Ethereum. Our results are surprising for two key reasons. First, they identify a concrete difference between the consensus layer security model required for blockchain protocols securing simple payments and those securing smart contracts. In a payment system such as Bitcoin, all independent transactions in a block can be seen as executing atomically, making ordering generally unprofitable to manipulate. Our work shows that analysis of Bitcoin miner economies fail to extend to smart contract systems like Ethereum, and may even require modification once second-layer smart contract systems that depend on Bitcoin miners go live. Second, our analysis of PGA games, priority gas auctions, underscores that protocol details, such as miner selection criteria, P2P network composition, and more, can directly impact application layer security and the fairness properties that smart contracts offer users. Smart contract security is often studied purely at the application layer, abstracting away low-level details like miner selection and peer-to-peer relayers' behavior in order to make analysis tractable. Our work shows that serious blind spots result. Low-level protocol behaviors pose fundamental challenges to developing robust smart contracts that protect users against exploitation by profit-maximizing miners and peer-to-peer relayers that may game contracts to subsidize attacks. To illuminate the behavior explored in this paper, we release a web dashboard, frontrun.me, that represents PGA data in real time. We open source all associated code and hundreds of gigabytes of raw data on the Ethereum PGA economy. We hope our efforts in general offer insight into the broad application and consensus layer risks created by ordering dependencies in smart contracts and into the effects of traditional financial market exploitation on blockchain consensus. So I'll just stop here for a brief minute and kind of recap, because the main focuses of this paper are 5 different kinds of events: pure revenue opportunities, priority gas auctions, miner extractable value, fee-based forking attacks, and time bandit attacks. And all of these 5 different kinds of events, attacks, stem from the fact that Ethereum is a smart contract protocol and not purely like Bitcoin in terms of a money payment system. And the interesting thing here is that even though, and this is their claim, that even though Bitcoin has been researched in this context before and found solid, what they're saying is that the moment there are additional levels, layers built onto Bitcoin, like some in the Bitcoin community are saying, whether that's Lightning or more sophisticated smart contract applications, that will force the Bitcoin community to reevaluate MEV for Bitcoin as well. Because what happens is when you have the ability for attacks with greatly different amount of value, or not attacks, but transactions that have really big differences in value, you can reorder transactions and do high-frequency trading. All 5 of those different kinds of attacks that they're going to be focusing on are, in some sense, you can think of it really simply on a high level as high-frequency trading. And that's what we're going to dive into with Section 2, Background. We now provide background required to understand PGAs. A. Smart contracts. Smart contracts are small computer programs executed without user intervention, often by a system that allows all of its participants to verify these programs' correct execution. Smart contracts often use a public blockchain network as the underlying infrastructure for their execution. Ethereum is currently the largest smart contract system that is Turing complete, i.e., it allows encoding of arbitrary smart contract functionality. Ethereum smart contracts have been used or proposed for a range of complex transaction types, including shareholder voting, stakeholder-owned investment funds and vehicles, fair exchange protocols for goods, complex key management solutions, video games, virtual casinos, and more. The most popular smart contract on Ethereum by daily active users primarily concerns virtual subcurrencies called tokens. These tokens can represent any scarce item, like a collectible resource in a video game or shares in a venture. The latter fueled a $12 billion token-based capital investment craze called the ICO boom. DEXes are a popular type of smart contract that allows users to trade such tokens in a non-custodial manner. B. Gas and fees in Ethereum. And just a note, this is from before EIP 1559. An Ethereum transaction either sends money to a non-executing account address or sends input data and possibly money to a smart contract address, representing a program stored in the network's state. Transactions are gossiped to all of the nodes in the underlying peer-to-peer network to signal their availability for inclusion in a future mined block. Transactions can be in one of 3 states: unconfirmed and not yet mined, confirmed and considered to have been executed, or rejected as invalid by the network of Ethereum peers. Ethereum transactions consume gas, a pseudocurrency reflecting the number of computational steps performed by a miner and other network nodes executing a transaction. Ethereum contracts may contain complex logic and loops, etc., so their gas consumption can only be determined via execution. Ethereum meters gas consumption via a fixed mapping from contract opcodes to units of gas. Every transaction submitted to the network for mining specifies a gas price, the per gas unit rate the sender will pay in Ether, or ETH for short. The gas price times the units of gas consumed determines the fee in ETH paid by the transaction sender to the node that ultimately mines the transaction. Bitcoin fees, by contrast, depend simply on transaction byte lengths. Transactions must also specify a gas limit, the maximum number of steps a network node should attempt before rejecting a transaction. The gas limit prevents infinite loops and other DOS vectors, and allows immediate verification that a sender has adequate available funds to pay the transaction fee, up to gas price times gas limit of ETH, and DOS is denial of service. So I'll just stop here for another short recap. Basically, what we have is an Ethereum transaction can either send money to an account address, like to a wallet, me or you, or it can send it to a smart contract address. The smart contract would then run the program based on the gas limit, sets kind of the max amount of steps in the program that it'll do, and the gas price would be the per gas unit rate that the sender is willing to pay times the actual amount of steps that are executed. So let's say I'm willing to spend 5 gas per step, and at the end my program spends 10 steps because that's the code I wrote, and then 5 times 10, so that's 50, and I set the gas limit at 100, so I'm all good. And maybe that's a very simplified version, but I hope that gets the general idea of like how gas works and what a smart contract is doing under the hood, because that will be very important for what an MEV attack actually looks like. Back to reading. Clients can also perform what is called a gas replacement transaction, resubmitting a transaction with a higher transaction fee, as in the gas price, times the gas limit, in the hope that miners will more quickly incorporate the transaction into a block. The mechanism for doing this is nonce-based. Each transaction issued on the network carries a nonce, and valid canonical blockchains must only include one transaction per account and nonce pair on the network. When a user reissues an unconfirmed transaction with the same account and nonce pair but a higher gas price, a miner will prefer the reissued transaction with it ostensibly higher transaction fee to the replaced old one. Note that a higher gas price only corresponds to a higher fee if the reissued transaction uses the same amount of gas as the replaced one, which may not hold true. Mining software assumes this to be the case, in part because computing gas consumption incurs the computational burden of executing a contract. Arbitrageurs leverage this heuristic to pay reduced transaction fees, as we detail in section VA. And I'll stop here just to recap that, because that's a really critical point. What they're saying here is that clients, when you want your transaction to go through, the Ethereum network is congested, what you send through MetaMask or XDeFi or whatever wallet you're using, kind of to ape in, a lot of them started using an ape emoji, you're telling the network that you're willing to pay a higher gas price and essentially a higher gas limit. And there's an associated pair, a key value pair associated with your transaction, the account and the nonce. And when a miner sees the same pair, but one of them is willing to pay more, they'll be like, okay, I'm going to take that one because they're willing to pay me more money. But, and this is the critical part, the higher gas price is only corresponding to a higher fee if we're actually using the same amount of gas as the old one. So if all of a sudden you change your computation and the amount of gas shrinks dramatically because all of a sudden the program is much simpler, for example, then the amount of gas will be lower. And so even though you're kind of telling the miner, hey, I'm willing to pay a much higher limit, in reality, the price you're going to pay will be less because the computation is less. So the gas per step is less. And the heuristic here that miners operate on is they don't actually run the transactions to see what the actual gas they're going to get. They kind of say, well, we'll assume it's the same transaction as before. And that's, kind of spoiler alert, that's a way for an arbitrage bot to trick miners into prioritizing their transaction over other transactions to get first in line. C, continuous limit exchanges. This is the third part of our background on Ethereum and Ethereum smart contracts. Classic exchange for trading stocks, commodities, and even cryptocurrencies generally share an accepted and common exchange design known as a continuous limit order book. Such an order book consists of a list of all open offers from buyers and sellers in the system. Prospective buyers place a limit buy order, which specifies a maximum price at which they are willing to buy an asset. Sellers correspondingly place a limit sell order. A centralized counterparty, the exchange operator, matches buyers and sellers, completing transactions automatically when there is a sell order on the books with a lower price than a buy order on the books. Orders are matched and/or placed on the books continuously by the exchange operator, which processes orders as quickly as possible in the order they are received. As soon as orders match, they are processed by the operator and trigger balance changes. D. Decentralized exchanges, DEXes. DEXes manage continuous limit order books using smart contracts. Traders or users hold their assets on-chain, and the smart contract plays the traditional role of exchange operator. Order books are typically maintained off-chain. In some DEX designs, a counterparty selects a fresh order in the order book and presents it to the smart contract with a signed counterorder. The smart contract executes the order and counterorder, clearing the order from the order book. Traders themselves thus perform order matching. This approach is used by EtherDelta and some applications of the 0x protocol. In an alternative approach used by, example, IDEX and Paradex, the exchange itself performs matching off-chain and submits order or counterorder pairs to the smart contract for processing. A more radical DEX design called an automated market maker, an AMM, bypasses order books altogether. The DEX consists of a smart contract that itself holds a reserve token and/or Ether. Consider two assets, A and B. The contract allows a user to trade between A and B at any time using its reserves as a counterparty at a set rate. If a user buys A using B, the price of A denominated in B offered by the smart contract for the next trade is increased. If a user instead sells A for B, the price decreases. In this way, single parties can trade without counterparty discovery or matching. Consequently, constant arbitrage between these and other exchanges is required to keep the rate offered in lockstep with the market rate for a commodity. Uniswap and Bancor are examples of such exchanges. And I want to pause here just for a quick reflection. This is the benefit of hindsight and reading a paper 3 years down the line. Most of you, I definitely don't know what the 0x protocol is. EtherDelta, don't remember these things. Uniswap, everyone knows what Uniswap is today. AMMs, automated market makers, those are the DEXs that have really taken over the past 3 years. What's interesting to see is that we shifted from a smart contract that mimics the TradFi world to going all in on a DeFi primitive where you can trust the smart contract without kind of mimicking the existing structure of how TradFi works with the order book. E. Front-running and profits through arbitrage. Traditional exchanges experience a classic form of predatory market behavior called front-running. In regulated markets, front-running is often illegal and has resulted in prosecutions and tarnished the reputations of financial institutions caught practicing it. Front-running generally exploits information asymmetries created by power structures within a financial structure. For example, brokers having privileged access to user information. Because there's no single party playing the role of a broker in decentralized systems, information asymmetries can arise for actors in advantageous positions in underlying infrastructure. Front-running can also occur based on changes in public market information, for example, reacting to breaking news that impacts stock prices. In this form, it's not only legal, but serves as the basis of a multi-billion-dollar high-frequency trading economy. One potential source of profit is price discrepancies across exchanges trading the same or correlated assets. Another is information asymmetries in the speed of processing or interpreting news. Automated market bots from high-frequency trading firms compete to profit from both at extremely high speed. They regularly build physical networks costing billions of dollars and approaching speed of light transmission across considerable distances. Many economists view this behavior as a zero-sum game that profits exchanges in the long term and argue formally that the existing of such rents is a fundamental limitation of market design that is a natural consequence of arbitrage opportunities across exchanges. This, however, remains a controversial viewpoint. We explore both cases, where bots front-run users and user orders and cancellations directly, in the event of a typo or market structure weakness, and use cases where bots exploit market inefficiencies to extract rent. We argue that both degrade the economic security of the underlying consensus protocol. Section 3. From decentralization to arbitrage. We've now gone through the introduction, we've gone through the background on Ethereum smart contracts, and now we're going to dive into from decentralization to arbitrage. In this section, we take a deep dive into particular examples of front-running, arbitrage, and high-frequency automated trading on a decentralized exchange. This concrete example will provide context for the remainder of our discussion on modeling this market and of its impact on the security of the underlying smart contract systems. One source of potential profit, price differences, seems inherent in an environment such as smart contract-based exchange. Today, blockchains operate with transactions processed in discrete batches, blocks. Furthermore, transactions are inherently dependent and therefore serial. Order failures depend on past order attempts, and in some exchanges, prices depend directly on order history, with multiple exchanges operating on the same system. It is possible that price differences will occur across exchanges while transactions in a block, and therefore trades on exchanges, are executed sequentially. A. Smart contract-enabled trade atomicity. Smart contract arbitrage opportunities have an additional distinctive characteristic absent in traditional cross-exchange arbitrage. Because of the atomic batch-based processing of transactions, and because transactions can themselves be initiated by smart contracts, it's possible to build bots that trade across exchanges through proxy contracts. These proxy contracts can execute batches of orders sequentially within a single transaction, reverting previous trades by throwing an exception if any trade in the batch fails. This means arbitrageurs have the opportunity to compose single transactions that execute multiple trades across multiple exchanges atomically with an all-or-nothing failure model. One example of such a transaction is buying an asset for price X and selling it immediately for price X tag that is greater than X. If performed atomically, these transactions together generate guaranteed revenue in the base asset. For example, a smart contract proxy could execute a trade buying a type X token for 2 ETH, and another selling it for 3 ETH. If both orders are on the books on some decentralized exchange, a smart contract executing both guarantees a revenue to the arbitrageur of 1 ETH. In traditional cross-exchange arbitrage, trades are viewed probabilistically, as there is a high likelihood that one of 2 trades will succeed while the other fails. This makes smart contract-based arbitrage in many ways simpler to observe, analyze, and study than traditional cross-exchange arbitrage, as bot intent is often explicit in order requests. In our measurements, we focus on a small subset of these multi-trade arbitrage opportunities, which potentially involved multiple decentralized exchanges. We restrict our focus to pure revenue opportunities. In these opportunities, a single smart contract-based transaction executes multiple trades across one or more exchanges, and the transaction generates revenue for the trader in every traded asset. A range of more complex and non-deterministic bot behavior exists, described in Appendix A, but they are outside the scope of this work. B. Pure revenue by example. There's a figure here, figure 1, that shows one example of a pure revenue transaction executed on November 15, 2018. In this transaction, 2 trades are executed on a decentralized exchange, Token Store, which features a design conceptually similar to that of EtherDelta. The first executed trade buys Freecoin, an obscure token. By inspection, this difference in rates is a clear result of someone using the exchange API and committing an off by 1 error, offering to buy tokens at 10x the market rate. And I'll pause here and just describe the chart. What's happening here is that there's trade number 1, where someone is buying free for ETH, and they're buying it at 0.14. That's the price. And in trade 2, they are selling it at 0.93. So quite a big difference between the price they bought it and the price they sold it. Back to reading. This created a cross in the order book, a sell order at more than a buy order would pay, which when both executed by the same arbitrage counterparty generates the flow of funds in figure 1, which is buying low and selling high. While this opportunity arose from a typo, a variety of revenue sources exist. For example, inconsistent price feeds or variance across exchange designs that respond to market movements at different speeds can also create pure revenue. Note that both orders are executed inside a single Ethereum contract and are executed in an atomic batch through a smart contract proxy. In general, we model each opportunity as a graph. As shown in figure 1, edges represent currency flows. And nodes are either exchange nodes, which receive currency and output another at the stated exchange rate, or asset nodes, which are either sources or sinks for same color trade subgraphs, depending on whether they are bought or sold. We label exchange nodes with the exchange name, and trade rate, and asset nodes with the asset symbol. The net revenue in each traded asset is the sum of the inflows minus the outflows in their corresponding asset node. So now they're just kind of describing this large chart that they have and they display, basically where they're calculating these kinds of trades over a period of time. To calculate the transaction profit, we subtract the cost from the revenue. In this case, the gas paid by the transaction that was mined by the arbitrageur. So, for example, transaction 0xC889 B9C4 paid a gas price of 134.02 gwei. Gwei, by the way, is the canonical unit for representing gas rates, where 1 gwei equals 10 to the minus 9 ETH. So 1 gwei is a very, 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 very small fraction of ETH. The transaction used 113,265 gas, approximately equivalent to 113,265 computational steps. It's worth noting that transactions that cancel their bids can use less gas, as they pay only for attempted execution. An execution requires costly computational steps. This will be relevant to later models in section VA. And I'll just stop here and remind you that we went through the cancel, what happens when an arbitrage bot or someone cancels their order and resubmits the same order with a higher gas limit, but doesn't actually run through the gas steps and kind of tricks the miner into thinking that they'll get more gas when in reality they're not. Furthermore, complex conditional transactions, price queries, or other computationally intensive order preferences will obviously cost more, making optimizing for gas consumption important in the development of competitive bots. The total cost of this transaction was therefore 113,265 times 134.02 gwei, which comes out to 0.0151 ETH, or around $5.13 at the time of the transaction, and already you can tell that this is out of date because there's no transactions these days with $5 in gas. But yeah, the associated profit was therefore 0.79 Ether minus 0.1518 Ether, which equals 0.77 ETH. Not bad. C, the third kind that we're going to be talking about, PGAs, priority gas auctions, ordering fees, and HFT. Ethereum transactions are routed in a peer-to-peer gossip multicast protocol by client node software. This means that all transaction information is available to all participants in this network, but earlier to participants with advantageous positions in the gossip topology. Additionally, nodes can simulate the outcome of every transaction given the current or expected system state. Once an arbitrage transaction is submitted, therefore, the sequence of trades it involves is publicly known by the network's peer-to-peer nodes. A natural question then arises: how is priority determined between arbitrageurs? Because each pure profit opportunity carries some computable profit P and is broadcast globally, a competitive game naturally ensues among arbitrage bots to be the first to execute an atomic transaction that exploits the opportunity. The mechanics of the system dictate that all subsequent transactions in the game will fail. How this particular game plays out depends on the peer-to-peer relay network mechanics of the underlying blockchain, as well as mining pool strategies and order books designs in the underlying exchanges. We present a greatly simplified model of this game formally in section VA. And I'll stop here just to recap that, because that's also an important section, definitely conceptually. The way that when you put a transaction into MetaMask, the way that consensus is reached and that transaction is added to the blockchain is through what's known as a peer-to-peer network. And this Ethereum takes straight from Bitcoin, and it's called a gossip protocol, and the assumption is that every node kind of gossips the transactions to the ones around it. And so my node will tell your node, hey, this guy wants to do a transaction, and your node will tell the nodes around it. So there is a time between when I've told a network that I want to do a transaction and between the time that it's actually committed in the next block that that transaction is out there for all to know, because it's a public gossip protocol. And in that time, arbitrage bots can see those transactions and then say, hey, this is a great transaction, but I would like to front run it. And then they can do a gas auction war and submit more gas so that they get priority and front run me. Back to reading. In Ethereum, the PGA game we observe consists of transactions issued with the same account and nonce pair, expressing a bid to a miner where the miner is paid gas fees as described in section 2b. We call this interaction of issuing repeated bids a priority gas auction, or PGA. To place a bid on an arbitrage opportunity, an arbitrageur simply issues a smart contract transaction with associated gas price G that atomically bundles multiple trades performing the arbitrage. If they later wish to increase this bid, either for strategic reasons or because they notice a higher bid that would eliminate their profit issued on the peer-to-peer relay network, they simply reissue the transaction with the same nonce and a higher gas price of G tag. If two arbitrageurs are bidding against each other, what emerges is essentially an auction, as shown in Figure 2. It's in the miner's interest to order first whichever transaction offers the highest price, if the miner does not plan on itself arbitraging the market. This approach will encourage arbitrageurs to bid each other up for transaction priority. And in Figure 2, I'll just describe it. What you see is over a span of 12 seconds, there are two bots, and each is offering a bit of gas, and the price, basically it's an auction, and the price is just going up steadily in a kind of exponential way until basically at the end of the 14-second chart, the chart ends, and I'm going to assume that the block actually reaches consensus and one of them wins. And the gas goes up exponentially, so someone here is paying a high gas price. What's interesting here, and I think it's worth opening the article and taking a look at these charts, and I'll link it, of course, in the podcast resources. but it's just how many bids are put in by these bots over the span of 14 seconds, right? And because these are bots, these aren't humans sitting and resubmitting a transaction, there are a lot of bids and counter bids here. So now I'll jump back to reading. Figure 2, which I just described, shows the action that occurs in such an auction from the point of view of the network. Each row in the associated table is a transaction observed by our Ethereum monitor on the peer-to-peer network using the experimental harness described in section 4. In this example, we set two accounts with nonce 1453 and another account with a nonce of 1512, bidding against each other for priority. These accounts issue transactions with ever-increasing gas prices. This is the part to pay attention to, I think. The first bot issues 42 transactions in 13.4 seconds. The second account issues 43 transactions in 12.1 seconds. In 4.94 seconds, the auction is over. The transaction that eventually ends up mined with priority is shown with a green star, and its transaction 0x and it's issued by one of the bots. So one of the bots is a winner and one of the bots is a loser, and this bot is considered the winner and pays the full gas price to reap the revenue as described in the previous section. This transaction was mined and blocked 6,709,727 by the mining pool hub, if any of you want to go check. The transaction shown in red square with a hash of 0xAA86 is also mined and included in the final block, as each account and nonce pair can include one transaction in the next block to be mined as per the protocol. Miners are incentivized to include even failed transactions, as these transactions pay for attempted execution. Note that while the winning transaction used 113,265 gas in execution, the losing transaction paid for 33,547 gas units, a far smaller sum. In game theoretic terms, each auction represents a variant of Alpe auction, where instead of paying their full bid, the loser is forced to pay a percentage to the miner. So that's where kind of you see the topic we were discussing earlier of the miners thinking that they're going to get a higher gas price, but the bot kind of flows an error flag and doesn't finish computing all of its smart contract, and therefore pays gas. It just pays a fifth of what the miner thinks that they're supposed to pay. And I think that's where we're going to call it an end for today. Naturally, got much less deep into this than I wanted to. Just read the first 6-7 pages, but I think this is a good place to start because there are a lot of concepts here that if you can get your head wrapped around while listening through audio and maybe even review them, that will be really beneficial to going forward. And I'll just kind of recap what we've been through, right? So this is a paper, Flashboys 2.0. You can think about it as high frequency trading in blockchain, but separately from high frequency trading, the impact here that this paper suggests and is actually playing out today in real time, 3-4 years later, is that these kinds of high frequency traders bring risk to the consensus layer of the protocol. And as a reminder, if there's no consensus layer for the blockchain, there ain't no blockchain. There's no consensus, there's no blocks, it doesn't work. And so this topic of MEV, minor extractable value, maximum extractable value, is a severe risk to the system. And what we've gone through here is we went through an introduction of just cryptocurrencies in general and the different kinds of attacks that we'll go through. Pure revenue opportunities, which we saw, priority gas auctions, which we just finished, minor extractable value, MEV, which we'll go into next time, fee-based forking attacks, and time-banded attacks, which we'll also get into next time. And kind of the key premise here is that these do bring a risk to the consensus layer. And even though this has been proven not to be the case in Bitcoin, what's interesting is if that Bitcoin will implement layer 2s and smart contracts in some kind of way further down the line, this will open the core Bitcoin layer up to this as well. Then we ran through just a background on smart contracts, how you calculate gas price, where there is a gas price, which is the per gas unit rate that the sender is willing to pay in ETH. And that's the fee. There's the gas limit, which is the maximum number of computational steps that the network node should do before stopping. And put together how much you're willing to pay per step and how much you're maximally willing to pay. That's the gas price of a transaction. And that gas really comes into kind of the spotlight, what we just saw in priority gas auctions, and also further down the line, because gas is what meters the demand for the network and where your transaction will get placed in a block. We spoke about continuous limit exchanges, which are basically classic order books, and this is how TradFi works. Then we ran through decentralized exchanges with the evolution of doing a smart contract that basically fulfills the role of an order book, all the way to the Uniswap model of today, the automated market maker, the AMM. And then we started going through the different attacks and the arbitrage opportunities. So pure revenue opportunities and PGAs, priority gas auctions, where someone is seeing that they can kind of shove themselves further in the line by paying more gas, and bots are doing this and arbitraging each other and us and paying that priority gas fee to the network. So that's where we're going to stop for today, and we will be continuing this read hopefully later this week. Hope to get this out kind of ASAP, and yeah, Ethereum Audible. Stick around.